Ask anybody and they'll tell you the first rule of investing is get out of credit card debt before you buy any investments. Well, actually, that's my first rule of investing. Ask anybody else and they'll tell you the first rule of investing is don't fight the Fed. Well, then why is nobody taking their own advice? The entire market seems dead set right now on fighting the Fed. Since the start of this year, markets have pretty much marched up and to the right, even though Jerome Powell told us on February 1st that there's going to be at least one more rate hike, probably two still coming. And then yesterday we got a hotter than expected CPI print, and that told us the Fed is probably going to continue tightening. And then this morning we got a red hot retail sales report. All of these things combined are telling us that the Federal Reserve is going to take interest rates higher and that they're going to stay there for longer. And yet somehow markets are insisting on grinding higher. They're fighting the Fed. They're breaking that first rule. I mean, take a look here at the S&P 500 since the start of the year. Pretty much up and to the right, not even stopping for gas. And even here since the beginning of February, since Jerome Powell told us more rate hikes on the table, since that hotter than expected inflation report yesterday, and even despite that red hot retail sales number today, the market is still heading higher. And looking over here at the NASDAQ, it's even worse, up and to the right, continuing to grind higher, despite all these indicators that tell us the Fed is going higher and it's going to stay there for longer. The market is fighting the Fed. Look no further than right here, the CNN Fear Greed Index sitting at 74, right on the cusp of extreme greed territory. This despite all indicators that the Fed is going to go higher and stay there longer. The market is fighting the Fed. Now, what you're looking at here is yesterday's Consumer Price Index report, and you can see up there we had 6.4% headline year-over-year inflation, but look at that 0.5% month-over-month number. January was a very inflationary month. And then this morning, we had this advanced monthly sales for retail and food services for January 2023. And zooming in on that report, check that out. 3% month-over-month increases in retail sales. American shoppers spent over $20 billion more in the month of January at retail stores than they did for the month of December. If Jerome Powell was hoping to see continued goods and services disinflation, this is definitely not what he was looking for. And where did that big bump in retail sales come from? Well, right here, America's consumer credit, i.e. America's credit card bill. And check this out, starting at the end of December, where we were at $933.8 billion in consumer credit, now to the beginning of February, where we're at $949.9. Almost all of that $20 billion in additional retail sales that happened in the month of January, it all went on America's credit cards. That is credit expansion. That increases the money supply. That is hugely inflationary. And the debt market can sniff this out. What we're looking at here is the U.S. 10-year Treasury yield. And you can see since the start of February, really since Jerome Powell's speech, the 10-year yield has started to rise. It broke out of this downward channel that it had been in since pretty much October, broke above the 50-day moving average. The debt market is telling us inflation is starting to surge again, and the Fed is going to be going higher for longer. The bond market has figured this out. The stock market hasn't. And check this one out here. This is the CME Group's Fed Watch tool. This takes interest rate futures and uses it to predict what the market thinks the Fed is going to do. And right here, this is telling us that at the next meeting in March, there is an 87.8% chance of another 25 basis point rate hike. But look all the way over there. They're actually starting to price in a 12.2% chance of a 50 basis point rate hike. A couple of days ago, that was down below 1%. The debt market is already pricing in a more aggressive Fed. Again, the stocks just haven't figured it out yet. And as we march further out in the calendar, now we're looking at the predictions for May. Right now, they're predicting a 70.8% chance of 2 additional rate hikes by May. That's up from about 50 a few days ago. And look, there's even a 9.4% chance of a 3rd rate hike between now and May. Going out even further to June, we're looking at a 47% chance of 3 rate hikes. And look at that all the way over there. Even a 5.8% chance now that the Fed takes us up another 100 basis points. That would be 4 25 basis point rate hikes. Folks, the debt market is calling it. We are looking at a tighter Fed for longer. And look, you don't have to take my word for it, folks. The Fed had all their usual jawboners out in full force today. Every single one of them forecasting more rate hikes higher for longer. Fed officials float even higher rates after brisk inflation data. And the sound bites here are just piled up all over the place. We've got Richmond Fed President Thomas Barkin speaking in a Bloomberg interview saying, if inflation persists at levels well above our target, which is what they are, maybe we'll have to do more. Also today, speaking at Prairie View A&M University in Texas, we had Dallas Fed President Lori Logan saying we must remain prepared to continue rate increases for a longer period than previously anticipated if such a path is necessary to respond to changes in the economic outlook or to offset any undesired easing in conditions. Then we've got Philly Fed President Harker out there saying he believes policymakers will need to raise interest rates above 5% and possibly higher to counter inflation that's easing only slowly. We're going to have to let the data dictate that, Harker said in an interview. It's going to be above 5% in the Fed funds rate. How much above 5%? It's going to depend a lot on what we're seeing. And then we've even got New York Fed President John Williams, who said yesterday that having the Fed funds rate in a range of 5 to 5.5% by the end of the year, as listed in the Fed officials' estimates in December, is the appropriate framing. 5 to 5.5%, that would be somewhere between 50 and 100 basis points from where we are today. In other words, at least 2 more rate hikes, maybe even 4. So even as stocks continue to march up and to the right, defying the Federal Reserve, we've got hotter than expected CPI prints. We've got blowout retail sales numbers. We've got increases in credit expansion. And we've got Fed governor after Fed governor coming out and saying we have to go higher and we're probably going to be there for longer. The whole market right now is insisting on fighting the Fed after years and years of telling us rule number 1 is don't do that. Till next time, live small and dream big.